What it do, fam? What it do, fam? I got an inkling this one's gonna go long, so let's go ahead and skip the intro. You're watching Sekki Deul, and today we're continuing what we're calling the Common Uncommon Question series based on a conversation that I had with a friend of mine who's been considering investing for a while. In the first episode of the series, we asked the question, why not real estate? Today, we're going to be addressing the other why not questions regarding Forex, commodities, futures, and mutual funds. For that reason, we're going to call this one, Why Stocks? Now, before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice of a paid professional. With regards to this particular series of episodes, we'd like to stress the importance of self-reflection at every turn. This is bare opinion, with a little bit of illustrated reasoning, but when it comes to investments, it's always healthy to take a fair bit of skepticism, regardless of the source, including us. I mean, how else are you supposed to figure out what's right for you if you don't? That being said, no mention of any stock should be taken as financial advice since we can't know what kind of security best suits you and your needs and your goals. We'd love it if you could like this video and subscribe to the channel though, and stick with us as we explore ways to figure out whether or not a given asset is right for you. For everyone who's already been with us for some time, we really appreciate your viewership. Mad love. Mad love. In any case, let's get to it. Alright, so in the past we've addressed the merits of both savings accounts and more recently real estate in comparison to common stocks. If you haven't seen them yet, I'll link them in the top right hand corner as well as at the end of this video for your convenience. Now, while these particular investment vehicles got their own episodes, we're just going to surf the waves of these next few options because our answers to the question, why not them, is a little more simple. So let's start at the top. Forex. Now, Forex is short for foreign exchange, meaning the trading of foreign currencies. And I guess local currencies as well, just the trading of currencies. There are a number of potential strategies that one may take when aiming to secure profits in the Forex markets. Now, while some of these may be based on simple buy and hold speculation, others are based on a concept that we have yet to touch on, but we'll be taking the opportunity to get into right now. And we're talking about arbitrage. Since the latter is more fun, let's get into arbitrage first. Now, arbitrage trading is basically the exploitation of pricing differences of an identical asset in a different market. An arbitrageur would simply buy an asset on one market and sell it at a higher price at another market. And let's illustrate this with a thingy. So imagine there's a pawn shop in Itaewon that's into the buying and selling of raisins. At this particular shop, they're buying a gram of raisins for 1,500 won and they're selling them for 1,600. Now, there's another pawn shop down in Haeundae in Busan that also in the raisin trade, and they buy raisins for 1,800 won per gram and sell at 2,000 won per gram. Do we know why this price difference exists? Not really, and it doesn't matter. Maybe Busan has a shortage of raisins, or they just happen to be really popular in this part of the country at this time of the year. Or maybe the shop just mispriced their raisin trade by accident. Either way, an arbitrageur who spotted this disparity would simply buy a sizable amount in Itaewon, head down to Haeundae, and offload the raisins for pure profit minus the cost of travel. This is arbitrage in a nutshell. Want a more concrete example? Well, if you've been on Money TikTok recently, you've probably seen some entrepreneurs talking about using Amazon FBA private label to buy products in bulk from Alibaba, have them shipped and repackaged, and then shipped to purchasers from Amazon with a significant markup. Actually, let's just have this random TikToker explain.
I buy products in bulk like this collapsible cutting board for $2. Have the supplier customize my packaging. Sell on Amazon for $16. It's called Amazon FBA private label.
Now, this is arbitrage in its most base state. You buy an item at a discount, then sell the item on a different market at a markup. If you find the right niche, you too can be a successful arbitrageur. Now, how does this relate to Forex? Well, Forex arbitrage is exactly this, but executed through the exploitation of price disparities in the Forex markets. This is made possible due to the decentralized nature of Forex markets, in which participants can be anyone from national banks to just a random dude buying and selling foreign currencies through a phone app. Due to the nature of the market, this provides ample opportunity for pricing disparities to arise, and for savvy arbitrageurs to pick up on the trend and quickly flip the assets for a profit. Why do people like Forex so much? Well, for one thing, the decentralization means very little regulation, which brokers take advantage of by providing individual traders significant leverage. Furthermore, the way that fiat currency is currently structured allows for virtually infinite gains and infinite losses. Regular mans could leverage themselves to the tits for the purpose of a single arbitrage trade, then profit many more times than they would have if they'd only used the money that they had in their account. Quick wins in big numbers are a big reason that the Forex market is so popular for home traders who wouldn't be able to do so with regulations and limited leverage in stock markets. On top of this, Forex markets are open 24 hours a day on weekdays, making trading a potential side hustle for someone willing to do some labor after they get home from work. But I guess it's time for the big question then. If the potential for big profits in the short term with a smaller amount of capital is so big, then why not just get good at Forex instead of wasting time reading reports, doing math, and maybe waiting weeks or months till the stock is at a good price? Well, 2 reasons. Let's start with number 1. I'm just not a trader. While I have done my fair share of trading and still do it when I have the time and attention for it, or when I see a good opportunity for it, the practice itself is both physically and mentally taxing. On top of that, the common statistic is that between 80 and 90% of traders end up net losing money. 70% don't last their first year, and 90% don't make it past the first 3. On top of that, new traders can lose a lot of time and a lot of money simply attempting to gain traction in the market when in competition with hedgies and more experienced traders. I also work full-time, I do this channel, do some free work for some friends back home, and I'm doing a master's degree, so I only have so much emotional energy and just time to spare for work, and learning to trade and trading, well, there just isn't space for it in my life right now. Plus, I don't know if you can tell, but I'm a pretty passive dude, and trading that actively simply does not fit with my personality. Also, 2. I have little interest in assets that don't perpetuate their own value. This refers less to Forex arbitrage and more to speculation based on buying and holding foreign currency with the hopes that the winds will blow the conversion rate favorably in our direction. While there's nothing wrong with this, the reason I don't use this strategy is that for the time spent waiting for the conversion rate to print, the money itself doesn't compound or provide any returns outside of the usually less than 1% interest rate provided by foreign currency accounts. If anything, I'd prefer to use it as a hedge in case the won bottoms out, or as a reserve in case I go to a country that uses that currency. To be candid, I do hold foreign currencies, but at the moment I just have them to use whenever I go to those countries. I just simply have no interest in applying Forex trading as an investment strategy. There are just too many things that go into currency conversion rates that we really have no control over or really no way to anticipate, so for me, it's a no. Alright, next we're going to talk about commodities and stock futures. Commodities refer to any raw material resource that's traded on exchanges like oil, gold, corn, soy, sugar, or even copper. Futures refer to contracts that allow you to buy or sell stocks at a certain price in the future. But these contracts also require you to pay fees for holding the contract until you execute, I guess. Hashtag Theta Gang. Now, even though my friend hasn't actually been investing, he has been perusing Wall Street bets for months since I suggested that he log in to indulge in all the loss porn. Since then, he's also seen a lot of people celebrating gains of over 2,000% and asked why I'm not active in options trading as well. Well, for one thing, 2,000% gains on short-term calls or puts, aka shorts, can easily just be 2,000% losses. Options are risky and the markets are crazy, and usually these gains are made on really risky bets that actually give them the opportunity to go up or down 2,000%. But there are ways to limit your risk, like covered calls, but I don't personally play too heavy with leverage, and nor do I really gamble, which is pretty much what this is. Common stocks are basically making hypotheses versus kind of just putting it all on black. Alright, now people really do like futures because, like Forex, profits can be unlimited, but at the same time, losses could also be unlimited, and uncovered futures are a great way to put yourself in debt with the quickness or to get a Lamborghini within the next 2 months. Again, I'm not saying that futures aren't a great asset for those who know how to play them, just saying that common stocks suit me, my goals, and my personality a lot better. Why not bonds? Well, let me be straight up with this. I just don't really understand the market or have time to commit to learning about it right now, and that's the honest truth about it. There's nothing wrong with bonds. I think bonds are very interesting, even though they have low yields. You can make a lot of plays in the bond market, but I just don't really know it. I don't have the time to figure it out. So let's get to the most interesting question that we posed. Why not mutual funds, or even I'm going to throw in index ETFs? Now, if you've watched this in the past, you probably know that we really think really highly of index ETFs and pretty fairly poorly about a lot of funds, since the vast majority of fund managers fail to consistently beat the returns of entire markets. We love that indexes are priced low enough that anyone can see some broad market action for less than the price of a nice bottle of whiskey. We love that the fee structure of index ETFs is consistently lower than 1%, and that's why we buy them. Look, we've made a case for indexes over mutual funds in the past, and if you want to see that video, feel free to redirect to the video in the top right hand corner right now. But it's important to note that even though we research stocks and do work really hard to identify good companies, we read reports and build portfolios, it doesn't actually mean that we don't actually buy index ETFs. Now, I'm likely never going to discuss my personal portfolio on this channel since it's really none of y'all beeswax. But I can say that I usually put 20 to 40% of my contributions into an index fund on a monthly basis and put the rest of it into my picks. Obviously, I'm putting more into my picks than I am putting into my indexes, but since the goal of my personal picks is to beat the market, I'm very much not trying to emulate it. So my personal portfolio is pretty concentrated, and I let the index itself do the diversification for me. But this raises the question: why even compete with fund managers playing with millions when I'm not? Well, in terms of sheer capital, of course funds and fund managers have way more money than we do, but there are some cognitive and tactical advantages to investing on the retail side of things. The first being, unlike managers, independent investors are not beholden to anyone but themselves. The income of fund managers and analysts is inherently tied to their labor and employment. For this reason, managers spend a significant amount of their time rationalizing their trading decisions to investors and their bosses even. This means that on top of researching stocks and making plays, they essentially have to write hundreds of pages on why they made decisions that they made, and that can distract them from what their actual job is. Now, an understanding of this gives a little color to the question of why fund managers so rarely deviate from one another. See, it takes diamond balls to even try to do something different, because if you fail, it's your failure and it's your ass on the line. But if a manager does what most of the other managers are doing and they all fail together, then there will be hundreds of fund managers thinking of hundreds of different reasons why they all failed, and each one will just be one out of a bunch of other ones who lost out together. Now think about how Michael Burry was portrayed in The Big Short. His investors and his bosses hated him for going against the grain even though he was right. And if the shorts had never printed, my guy would probably have been sued into the ground by his investors and employers and eventually run off Wall Street. For me, if I fail, I can just learn from it and get better next time. I lose nothing but what I was willing to risk, and for that reason, it's easier for me to operate outside of the herd and to buy the picks that I like. Now on top of this, I'm also not playing with a lot of money. It's much harder to get really high returns when playing with multi-millions of dollars than it is when trying to get higher returns moving the compounded accumulation of some splits of my paycheck over the past few years. This is not just due to frictional costs like higher fees and taxes, though that is a big part of it, but it's also due to the fact that I don't feel the need to diversify my stock picks for two reasons. One, I already told you, I take care of my diversity by dollar cost averaging into an index. Two, I trust my gut and I trust the work that I put into finding good stocks. Now, common stock picking really isn't for everyone. Futures are not for everyone. Forex is not for everyone. No asset class is for everyone on a personal finance basis, except for potentially index and bond ETFs. But hopefully, over the course of this video, you've had some time to think about what's right for you. Now, if you've done your reading, you may know that of all the asset classes over the past 100 years, common stocks have far surpassed the performance of pretty much any others. And although I could have just said that at the beginning of this video, I don't really like to use it as a rationale, because that's, even though it's a great statistic that kind of makes me feel good about investing, it's a backwards looking statistic. I can't go back in time and put 10K into American Express. At best, it's a great stat for rationalizing to yourself that you should be investing. But as a forward-looking stat, it really doesn't do anything. Alright, I knew this was going to go long, but if you're still with us, I appreciate you to the most. This mad love to those who are sticking with us through this whole YouTube thing. And we're going to cut it short now because it's been long. So good luck in your investing. We'll catch you next time. Peace, family.